Hey everybody, welcome back to the Velocity channel where this is your bridge to financial freedom. Today we have an exciting one today because someone asked a question, right? Absolutely. And many times questions are the answer. And they said, CJ, how in the world did you say that guy got paid back? How did he pay up his line of credit when he's paying $1,000 each month towards the interest and principal payments off of his car loan? We're going to show you that and much more in this video. But before we do that, what you got to do? Like, share, and subscribe so that people all over the world can find out how powerful Velocity Banking is. Are you ready? Let's go ahead and do it. So CJ, how did he fill up his line of credit again? Well, first of all, he's got some income coming in, okay? Number one, right? Each and every time you make sure that income is coming in. Now, that's not the most important thing, right? We also got to make sure those expenses, right? Those expenses are in line as well. In this case, income minus expenses equals what? The cash flow. And in this case, it's $2,000 in this scenario. Now, remember, as you're paying it back, how much do you want to keep in the line of credit? Trick question, that's up to you, okay? But make sure that you're utilizing the line of credit as much as you can, as wisely as you can. And we're going to go ahead and show you some pointers right now. The checking account, let's just say you got $5,000 there. I'm going to bring out a point here. Your line of credit, let's just say you got $25,000 there, and each and every month you're cash flowing $2,000, right? Look at this. Do you really want this money to stay there? We've been conditioned, right, to make sure that we are not using that line of credit. How many of you have been conditioned? Don't use it unless you have to, right? We've been conditioned, hey, keep that money, save that money, right, in your checking or in your savings account. But what we haven't been conditioned to do is knock down the principal payments, because the interest is where the banks make their money. Did you know that? So wouldn't it behoove us to make in the same manner, to make money the same way the banks are making money, by interest? Because they know about interest. That's why they earn it. Us, we were taught not to know that much about interest. That's why we pay it. And we say things like, don't rack up that line of credit. Save your money, right? Oh, that's good. You got cash flow going in. Guess where you're going to put it? You're going to put it in your checking account. We're going to make sure it accumulates. But what happens? Life happens, doesn't it? And you got to use that money. And guess what? You still have all of these debts. And so while you're going through Velocity Banking, remember the mindset behind it. And that is, we're going to make interest work for us. That's why I'm called an interest cancellation specialist. That's what matters in money. We are going to make interest work for us. Did you know that interest is actually in some ancient writings as well? So it behooves us to make sure that our priorities are in line. Let's knock out the debt, okay? Let's use the money that we've worked hard for, right? And our reputation. That's what the credit is. The credit is based off of your reputation, your spending reputation, how you utilize the lines of credit, how you utilize the credit cards that's given to you. And even the increases based off of your credit reputation. So this $25,000, would it behoove you to just let it stack there, let it stay there, let it be stagnant, or to use it? I believe that these soldiers need to be deployed. Now, before we would tell you how to get rid of your mortgages, but then we found out, right? Hey, maybe you don't need to get rid of them as fast as you thought, because they're actually way high on the cash flow index scale, all right? Maybe you want to actually get rid of your either student loan or car loan first. So let's go ahead and switch out this 25K. Let's switch it out with this 25K, since we know it's getting calculated differently on the car loan side. Believe me, working at a dealership, it's getting calculated. Okay, so you want to switch those out. You want that simple interest, instead of the car loans, loan payments, and that schedule that they have you on. So that's what you're doing here. You're actually going to be transferring the debt from the car loan debt into your line of credit so that you can pay that off faster, because the interest is calculated in a much, not easier, but a more simple way, hence the term simple interest. Does that make sense? All right, so cash flow. We're going to use the cash flow, the $2,000 of cash flow. We're going to keep it there each and every month. That's why the income goes in to the line of credit. If you don't want to use all of your income, you don't have to. But that income is going to go in, then the expenses are going to go out. In this scenario, he uses the line of credit as his new checking account. Therefore, his income goes in, $5,000. His expenses go out of the line of credit, $3,000. And he's left with about $2,000 right there in the line of credit. But how is the line of credit getting paid? Does anybody know that? By the cash flow. He's just not writing a check or signing online and paying it. He's already paying it, when he gives his income to the line of credit. It's already been paid. $5,000. Boom. The minimum payment's less than that. So the lender's like, whoa, hey, we like this person. Oh my goodness, they give us $5,000 each and every month and they pay it off. Right? So what's 25,000 divided by 2? Oh, excuse me, 2,000. 25,000 divided by 2,000. You want to go ahead and do that? That's how many months it'll be until you pay it off. Maybe even more. Maybe you want to put more towards the principal. Okay? Maybe you want to get some assets, right? Some real estate. Have more cash flow in here. Because the bigger the cash flow, the steeper the pay down, the faster the payoff. And so it's up to you. Just realize that the ebbs and flows get better in velocity banking as shown, right? Before, you would have just divvied your money up, right? You would have, from the checking account, you would have had to pay the $2,935. You would have had to pay this, whatever that minimum payment is, and my goodness, $250,000 for the student loans. You see what I'm saying? But not anymore. You're utilizing consolidation, but you're not consolidating loans. You're not doing any of that. You're consolidating the lines of credit. And you're saying, no. I can go ahead and pay this off. Then I can pay this off, the mortgage. Then I can pay this off. CJ, how in the world did you do this math? Do you really care? I can definitely send you the video. Yeah, I can show you how to do the HP B2 calculator if you need. Absolutely. We can do that. No problem. No problem. That's why the minimum monthly payment on that is $2,935 a month. And I'll show you how to do that. If you'd like, just let me know. All right? You don't need to continue to do banking as you've done it because, is it working for you? If it's working for you, go for it. But if it's not, at least consider another way. All right. And of course, we have an automated method of doing this. So you don't have to draw on the whiteboard or get yourself some chalk and a chalkboard or maybe a pen and a paper. You don't have to do that. Not anymore. We have a cash flow management system. So this is what it's all about, though. Making sure those interest loaded loans are transferred out with something that's not and is a revolving account, like a line of credit, like a credit card. All right, folks, I want you on top. I know you are. You're winning because you're a velocity banker. God bless, and you have a great night.